Hi, I'm Linda Eedes, and I'm joined today by Rashaad Tayob, who is one of our portfolio managers, both on our multi-asset funds as well as our fixed income funds, and who also contributes to macroeconomic strategy. And the latter is what we're going to be talking about today. We're going to be talking about the Fed versus the market, who will be proven right in 2023. So, Rashaad, is the Fed at odds with the market at the moment?
Linda, the Fed and the market are definitely at odds at the moment. The Fed believes that they will be able to maintain rates at a high level for a long period of time, while the market is seeing rate cuts by the end of the year. So we haven't even finished the tightening cycle, but the market is already pricing in rate cuts. The Fed is focusing on inflation and bringing that back down to 2%. The market is seeing the prospect of a slowdown or even a recession this year, which will necessitate sharp rate cuts.
So how big is that gap between the Fed and market expectations at the moment?
So we recently saw a 25 basis point increase, taking the Fed funds rate to 475, upper bound. The market and the Fed are both seeing a further 50 basis points worth of hikes, taking us to 525. But from then on, the Fed believes that rates will be able to maintain above 5% for the rest of the year, according to their most recent dot plots, while the market is seeing 2 to 3 rate cuts by the end of the year and rates falling below 3% into 2023.
And so why is this big discrepancy between what the Fed is expecting and what the market is pricing in?
So inflation in the US is still at above 6%. It's 6.5%, and the Fed is very focused on bringing that back down to the 2% level. The market is already looking past that. They're looking for the potential for higher interest rates to take its toll on the economy, the potential for a slowdown or even a recession this year that will force the Fed to cut rates. So I think they focused on different things. The Fed is focused on inflation, the market's focused on the prospects of a recession.
And so is the market not concerned about inflation in the short term?
I think the peak fears in the market were last year, the Q3, where the peak fears of rates and inflation were apparent. Since then, the market believes that the inflation fight is behind us. If you look at what inflation is being priced into the market for 2, 5, and 10 years, it's all around the 2% level. They believe the fight against inflation is over, and the biggest risk now is the prospect of an economic slowdown or recession.
And so, Rashaad, probably the biggest place that we can see, the manifestation of that discrepancy is in the positioning of the yield curve at the moment. What are we seeing there?
So if you think about what an inverted yield curve means, it means that longer end rates are lower than short end rates. It means that the market believes that rates are going to be coming down. And why would it believe that if it believes that a recession is coming?
So given that this has been a very reliable indicator of a forthcoming recession in the past, I'm assuming that we actually do believe the market in this case. So does that mean then that we think that there's going to be a recession likely this year?
As I mentioned, each inversion has been followed by a recession. So we have to take that signal very seriously. And if you look at the Fed, it hasn't proved itself to be too accurate in recent times. Inflation went over the course of 2021 from 1.5% all the way to 7%. And throughout that time, they were talking about inflation only being transitory. They didn't take the problem seriously. It was only in March 2022, when inflation was already above 8%, that they first delivered a 25 basis point cut. And by being so behind the curve, they were forced to hike rates aggressively, which have quite a negative impact on the markets over the course of last year. So they've proved themselves to be quite inaccurate in terms of their ability to forecast inflation, forecast the economy, and therefore I'd really back the yield curve as a better predictor than the Fed going forward.
So that's looking at the economic landscape. What does that mean for how we positioned in our portfolios? Because of course, what happens in the economic cycle and the market cycle can sometimes not be in sync.
So I think, Linda, it's very important to draw a distinction between the market and the economy. So just as markets fell in 2022, even though we avoided a recession, it's very possible that in 2023 we might hit a recession, but because of valuations and the potential for rate cuts, markets can actually deliver reasonable returns. So when we look at our portfolio construction process, it's important to focus on valuations. If we are buying the right asset classes or companies at the right valuations, that will deliver better returns over time than trying to forecast a recession.
Okay, great. Thanks very much, Rashaad, for your contribution, and thank you to everyone who's joined us today.